Good day, and welcome to Zinka Logistics Solutions Limited earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Abhilasha Aswal from Zinka Logistics Solutions Limited. Thank you, and over to you, sir.
Thank you and good evening. Welcome to Zinka Logistics Solutions Limited Q3 FY25 earnings call. Please note that a copy of disclosure is available on the investor relations section of the website as well as on the stock exchanges. Anything said on this call which reflects the outlook towards the future or which could be construed as a forward-looking statement must be reviewed in conjunction with the risks that the company faces. Please note that the audio of the earnings call is the copyright material of Zinka Logistics Solutions Limited and cannot be copied, rebroadcasted or attributed in the PR media without specific and written consent of the company. To give you an in-depth understanding of the company and answer all your queries, we have from the management side, Mr. Rajesh Kumar Naidu Yavadi, CMD and CEO, and Mr. Satyam Naik, CFO. With this, I would like to hand over the call to Mr. Rajesh. Thank you.
Good evening, everyone. Welcome to our second earnings call. As a public company, this is our second quarter of performance, and we will walk you through what has happened the last quarter. Jumping straight into the snapshot of the results, first, I think there is a lag. I think this is probably not working. Yeah. So jumping straight into the, results, the snapshot of Q3 is in front of you. We did close to about 123 crores in overall revenues, which is close to about 45% growth on a year-on-year basis. Because of the nature of revenues in our business, which are largely software in nature, right, and hence the direct costs of the business are fairly low, most of the revenues convert into contribution profits. We, at a contribution profit level, have done close to about 93%. That has been the trajectory largely over the course of last 2-3 years as well. So we made close to about 115 crores in contribution profit, which is a 48% growth on a year-on-year basis. With a model where revenues compound continuously and customers we have acquired over the period of time, there is no incremental cost of acquisition. There's a very strong flow-through of revenue growth into adjusted EBITDA. And this quarter, we've been able to deliver an adjusted EBITDA of close to 42 crores, which is close to 5 times growth over the last year. From last year, we did close to about 3.5 crores and 7.5 crores in adjusted EBITDA. That number now has gone to 42 crores. And these are the top line financial metrics. Most of them get delivered by active work on operating metrics. Few operating metrics to discuss. The number one is number of customers who use us. This is the metric on transacting customers in the last quarter for us. We have 7,35,000 transacting customers, which is a growth of 21% on a year-on-year basis. Then these customers, broadly, again, if you look at it, these are like in excess of 20% of India's truck operators who are transacting with us and loyal to us. In these users, not only that they use us for probably one service, a lot of them use us powerfully. 350,000 users, which is roughly half of the users of the transacting customers, are using greater than or equal to 2 services on the platform, which on an absolute basis is roughly a growth of close to about 30% on a year-on-year basis. One of our largest revenue verticals is payments. Under payments, we make revenue, when the proxy for making revenue comes from the GTV of payments. We made close to about 6,100 crores of GTV in the payments vertical for us, which is a combination of tolling and fueling payments. And that's a growth of close to about 35% year-on-year basis. Right? So at a broad level, to summarize what we have done, we continue our trajectory of consistent profitable growth because most of our profits, all the profits are coming in from our core verticals, which today are market leaders from a perspective of market shares, from a customer NPS perspective, customer love. I think we're doing phenomenally well. Those are growing at a very healthy pace. While we continue to invest into newer growth opportunities, sort of which gives us a balance in being able to deliver profitability at the same time, continue to keep our goal at, redefining India's trucking and continue to go on onto that particular path. Now, again, at every earnings call, probably I will narrate our problem statement which we are solving. So this is our trucking industry where, for India, we spend 15-16% of India's GDP we spend on logistics. And Indian logistics gets executed dominantly through trucks. Indian trucking industry is a $200 billion industry, which is fast growing, largely operated by small and medium scale truck operators. 75% of these guys own less than 5 trucks. Right? Now, if you look at the life cycle of this particular truck operator, right from buying a truck, which again makes a truck costly by like 10-15% because of intermediaries in the transaction, to financing a truck where half the industry is local pawnbroker led with interest rates of like 24 to 48%. Then getting access to loads where there is again dead wastage of days because a truck runs in India only for like 14-16 days, a month. Remaining time he's searching for load, waiting to get unloaded, etc. Right? So, and on a transaction, he again loses 15-20% of the brokerage commission, right? So if you pick up any value stream in a trucker's life, right, it is typically delivered through intermediaries and is inefficient. This leads to India's trucking, being, inefficient. And this is something which is the root cause for India's logistics being bottleneck, India's logistics being high cost. And we believe that the route towards transforming this is to really transform the life of the truck operator. This is the mission we have chosen, in the midterm for us, probably for the next 5-10 years, we'll be solving at the core for the fleet operator. And through solving for that, we will try to dream about how can we transform India's trucking. Narrowing that down into really, what's our strategy to, go after this particular problem, right? So to go after this particular problem, there are 3-pronged strategy. One is offerings. Offerings is nothing but a resultant of problem solving for this particular customer base. Year after year, quarter after quarter, we've continuously picked up problem statements for our customers and we have solved them because technology, right? Because technology is a lever to solve like most of these particular challenges, and we've been at it to solve them, right? As you can see, with in the myriad of solutions we provide for the truck operator, a lot of them are in the growth phases and nascent phases of development, and the core verticals are tolling and GPS, which contribute to 87% of our revenue. And we continue to execute in this direction of problem solving for our customers. Second area is the whole platform. Our customers get their services delivered through the mobile app. They come and use the platform. Platform continues to get stronger, year after year, quarter after quarter. We have close to about 20% of India transacting on our app, and their usage continues to go up, right? If you can see, there is one vertical called as Fleet Docs, right? That's a feature for truck operators to manage all the documents at one place. Their fitness certificate, right? Their pollution certificate, any challan on, their vehicle driving, etc. All those alerts, insurance expiry, everything can get managed at one place, right? So such a feature creates higher utility for the, app for the customers. He starts spending more amount of time, right? And as and when we keep improving each of our, existing features, he spends more time, right? So 45 minutes is the daily app usage in this quarter for our customers, which has moved up significantly, about 15% over the last year, which was 39 minutes, right? So this continues to compound. But as the nature of our customer, right, he essentially needs hand-holding. Our entire acquisition and servicing is offline. We have a 9,000 physical touchpoint network across the country, which sells and services to this particular customer and which has 80% presence, right? So this is the strategy we've followed for the last, 4-5 years. We continue to double down on this particular strategy, and this strategy, is delivering. Right? So, so that's the problem we are solving. This is our strategy, in the midterm, for the next 5-10 years, how we will execute to get closer to solving this particular problem. Now, giving you a snippet of the operational metrics, growth, right? Starting with monthly transacting truck operators, which I've spoken about, on a year-on-year basis, we've grown close to about 20-21%, moving from 6.1 lakh truck operators to 7.4 lakh truck operators in this particular quarter. That's a year-on-year growth of 21%. And next metric is on power usage. 45% of these users are using greater than equal to 2 services on the platform, where there's a growth of 30% on a year-on-year basis. Then these users spending more time with us. 39 minutes was their usage in the last year, same quarter. Now that number has gone to 45 minutes, which is roughly 15% on a year-on-year basis. So that's the metrics at a very broad level that, in our overall marketplace, which we have floated in our whole platform, are customers coming, using us, and are they transacting? Next, moving to some of the metrics which define the kind of, kind of volume at which they are transacting with us, right? So core vector of, measure there is the GTV on payments. GTV on payments, we've done close to 6,100 crores in GTV on payments this quarter, which was 4,500 crore last year, same quarter, which is a growth of 35% on a year-on-year basis. In terms of the number of payment transactions, it was about close to 10.6 crore transactions in the last year. Now that number has moved to close to 14.5 crore transactions this year, which is close to a 36% growth on a year-on-year basis. And I'm not narrating, but most of these numbers are largely tracking the 9-month growth as well. Wherever 9-month growth I need to highlight, I will highlight there, but largely they'll be tracking the same number. As a result of activity increase, as a result of volume of things which are happening increase, our gross revenues are compounding. Our gross revenues have compounded by 45% on a year-on-year basis, moving from 85 crores in quarterly revenues to 123 crores in quarterly revenues, this quarter. And if you remove the interest income, because of IPO proceeds gave a little bit of kicker, the revenue from continuing operations have grown at 41% on a year-on-year basis, from 81 crores to 114 crores, right? And a strong sequential quarter growth as well, of about 15% from Q2 to Q3, the number which is not present on the deck at the moment. Revenue from growth businesses, which is if you leave out the core verticals of tolling and vehicle tracking, that number has grown from 7 crores to about 14.5 crores, which is close to doubling on a year-on-year basis. Now, all these metrics, when they flow into contribution profit has grown at about 48%, growing from 77.5 crores to about 115 crores in this particular quarter, right? And contribution margin percentage, which I was mentioning, nature of the business has not changed. So the contribution margin levels are in the range of the 91 to 93% levels this particular quarter, which was similar, the last quarter as well. And because of all of this happening and the quality of revenues, adjusted EBITDA has grown much more stronger than all of this because of operating leverage at play. Most of the revenue growth flows into adjusted EBITDA. This is what we have spoken to most of you, over the course of the IPO and the last quarter. So you can see we've delivered an adjusted EBITDA of 42 crores this quarter, which is a growth of close to 5 times from the previous year quarter, where we did 7.5 crores, right? So, and if you even remove the interest income, this is a line item we are introducing for the first time. Most of the metrics we've continued reported at the older adjusted EBITDA. Over the course of 2 to 3 quarters, we'll move everything to adjusted EBITDA, excluding other income, because that is the right metric to measure. There, from a 3.4 crore last year, we have grown to 33 crores this year, which is again a growth of roughly about close to 10 times, over the last year. So overall, as you can see, a very balanced growth from an overall revenue perspective, very strong growth on profitability because of operating leverage at play and the nature of the business is playing out, and continuous, aggression on the new initiatives, as I will outlay as we move forward. So summarizing the key highlights from the numbers we have seen, right? The first part I will comment on the core businesses of the company, right? We've continued to maintain strong growth momentum on the overall, business, growing at 45% from a quarter-on-quarter basis, and 9 months 50%. What is important to track is that the core businesses continue to compound 35% this quarter growth, 43% 9 months growth. In the discussions with most of you, you've seen that even in the DRHP, the first, one of the biggest risks disclosed in our revenue is the FASTag program management fee, which is linked to government policies. Right? And roughly about between 30 to 35% of our revenues come from such a line item, right? And what is important to note is that in the past, government had given minimal visibility into how this particular program management fee is going to track into the future. What we are pleased to report is that in January, government has come out with a notification clarifying really what this MDR, what this program management fee is going to be in the future, which gives a very strong cementing to the revenues, the quality of the revenues, and the revenue visibility and predictability for our company into the future, which will help, us plan things better. So on an overall revenue, the update is that we're growing strongly, and the quality of the growth and the quality of the revenues continue to get cemented. Coming to the next line item, in terms of new business verticals, we keep doing a lot of work. More importantly to note, management teams, 80% of the bandwidth typically goes into really driving the new initiatives growth, because the core initiatives are really well oiled, doesn't really need that much of management from bandwidth from a management side, right? So one of the vectors, one of the new businesses which we've been incubating over the last 18 months was the area of fuel sensor. Fuel sensor was an initiative under the telematics hood where we were selling, units, but we were not able to sell at a particular price point where the Indian truck operator would be able to leverage value from that. We were able to really re-engineer that particular device, work with our suppliers, over the course of period in Russia and in China, over the past, 18 months, and were able to launch a device at a price point where we are able to get the customers, get more value at that particular price point, right? And we were able to build the whole installation and service network in parallel to that, for fuel sensor. These two initiatives went live over the past 6 months. That led to a growth where the total sales we did in the last quarter is equal to the total lifetime sales we did till that point in time, right? So we've been able to unlock a category which basically will stabilize in the course of the next 24 months, and we will be able to give rise to a new vertical which will deliver revenues equivalent to the current, overall telematics revenues, right? So that's a big unlock for us, and we believe that in every 6 months we'll be able to create such a big unlock as we keep, explaining you and delivering, the earnings results, quarter on quarter basis. Then next metric is on platform engagement, because those are the lead vectors of growth for revenue, because we need to acquire new customers, our GTV growth needs to keep coming through, and users need to use us more. On a year-on-year basis, as I reported, we've grown on in excess of 20% on the monthly transacting truck operators. Our payments GTV growth has come through at 34%, and users are using us more by spending 15% more time on a year-on-year basis. So that is the lead vector of growth where we are fundamentally, getting stronger year-on-year, right? Now, moving to profitability metric, as I mentioned, in this financial year, already at a 9-month level, we've delivered 85 crores of adjusted EBITDA profits, which is our operational profitability metric. Which same thing, previous year we did 3.4 crores, which is a jump of 88.5 crores over the last financial year. And speaking about the quarter, from last year 7.5 crores to this year 42 crores, which is a jump of 35 crores. So very strong profitability performance, which we've always, articulated that we are in a technology-led business where you will see strong operating leverage. We have minimal increase in cost year on year, but we continue to increase our acquisitions and we continue to increase our revenue, at a much stronger pace as we keep, delivering momentum. Talking about operating leverage, because I've used that word multiple times, in the course of my presentation. We presented this slide, same slide last quarter, presenting the same slide again. You look at Q3 FY25 to Q3 FY24, we've grown in revenues 38 crores. Adjusted EBITDA has grown 34 crores, which is a 91% efficiency flow through on a year-on-year basis. Same thing looked at a sequential quarter basis. If you look at it, Q2 FY24 to Q3 FY24, our revenue has grown roughly about 15 percentage points, which is 19 crores growth. Adjusted EBITDA has grown from 25 crores to 42 crores, which is 17.5 crores growth, which is again on a sequential basis, operating leverage of 93%, right? Again, there's no secret sauce to this, no hidden sauce to this. That secret sauce we've explained multiple times. This is happening because majority of our revenues are recurring in nature. We acquire customers, but these customers' cost is, charged off in the P&L, in the sales and marketing cost in this quarter. But these customers, once acquired, because the kind of products we've built, they are sticky and our annual churn is quite minimal. So the recurring revenue continues to compound. Right? Second aspect is that inside the recurring revenue, one more compounding impact is that these customers offtake and take up newer services. When they take up newer services, the revenue of these customers continue to compound. Second lever, when these revenues grow, the efficiency at which they convert into contribution margin is very high. With a 93% contribution margin this quarter, revenues have converted into contribution margin. Third, year on year, the net revenue retention is very strong and user retention is very strong. That leads to revenues compounding at a much faster pace. And all of this happening without any investment in assets, because we don't have to invest in any hard capex. Like we're not running in any balance sheet heavy business. So it's an asset-light model. All of this results in typically our adjusted EBITDA mimicking our cash flows, and our revenues typically flowing down to adjusted EBITDA with an efficiency of in excess of 90%, broadly in the range of 75 to 90% depending on quarter, right? So essentially, truly a platform led revenues at work, which has a strong is driving a strong P&L with a very strong operating leverage. And if you map out the EBITDA chart consistently across the last 7 quarters, if you look at it, we've grown in the last 7 quarters from negative of 6 adjusted EBITDA. Continuously, we've grown every quarter on this sequential metric because of the operating leverage, and we are able to deliver 42 crores in this quarter. And that number, if you look at it, from a negative 9% has moved to plus 34%, like in a 1.5 year sort of a horizon, which is like a plus 44 percentage points turnaround in profitability, which we've been able to manage because of high gross margin, because of operating leverage, which is helping us deliver this. Coming back into basics in terms of explaining how the P&L looks like. We've covered the operational metrics, we've covered operating leverage. Now back to P&L. Broad repetition of what I've spoken before. Revenue from operations grown at about 41%, total income at 123 crores, growing at 45% year on year. And as I mentioned, minimal increase in direct costs. Direct costs should have grown at revenue, but they are not because of leverage in the operating costs as direct costs as well. So they have only grown at about 11%. Contribution margin has grown at 48%, and total expenses, if you see on a year-on-year basis, have only grown at 4%. Despite a very small growth in total expenses of the company, remember that we are aggressively investing in new initiatives. We are aggressively and increasingly acquiring more customers on a quarter level in each of our business verticals, which led to our adjusted EBITDA coming to about 42 crores, which over last year has grown about close to 5 times from 10.5 crores. And from adjusted EBITDA, if you remove the other income, 42 crores becomes 33 crores compared to 3.5 crores last year, which is close to about 10 times growth over the last year. Now talking about much more stringent metric, which is PAT. In PAT, excluding exceptional items, in exceptional item we largely have the share-based payment cost, which is a one-time cost, which from Q2 and Q3 that cost is over. So you can assume that exceptional items from a share-based payment cost and IPO one-time IPO link cost also over. So if you remove those two costs, PAT of the company this quarter is 30 crores compared to negative 6.5 crores last quarter. At a PAT level also you can see a turnaround of close to about 37 crores of profitability turnaround from a year-on-year basis. And overall PAT obviously negative because share-based payments is impacting this and one-time IPO cost is impacting this. But with facts on the table and with the facts which are known to us at this point in time, with sufficient confidence we can probably give you a bit of guidance that we will probably not be having these exceptional items in the coming quarters. Probably in the immediate quarter we can expect none of these exceptional items to be repeating in the continued operations. So you may be seeing very fast PAT excluding exceptional item and discontinued operations mimic the PAT at an overall level. Giving you a walkthrough of PAT to adjusted EBITDA, broadly simple. From PAT of negative 48 crores this quarter, exceptional items is the biggest number of 78 crores. Then your depreciation amortization is roughly about 8 crores. Your ESOP cost is roughly about 3 crores. Which gives you the adjusted EBITDA number of 42 crores, and other income of 8.98 crores makes the adjusted EBITDA other income to 33 crores, right? So that's broadly what we have, and would love to open the floor for questions.
Thank you very much. We will now begin with the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and one to ask a question. The first question is from Sachin Dixit from JM Financial. Please go ahead.
Rajesh and team, congrats on a great set of results. My first question is more of an explainer. I love to have some segmental color on the business. When you say, for example, growth business are growing 100%, can we break down some of it? Where is it coming from? Secondly, again, because it's a bit tough to triangulate, right? You combine core business as tolling and telematics. But when we are looking at GTV, we are getting premium GTV, which is fueling and tolling. So it's tough to triangulate for us. Would love to have some more clarity and some more breakdown if that's possible.
Yeah. So probably we are waiting for businesses to probably touch at least 15 to 20% of the revenue contribution where they are a bit material, or at least on an absolute basis, if they can contribute to an annual revenue of at least 50-60 crores. I think that's when we wanted to start giving out segmental, understanding. But, from your question, let me give some color on what's really happening under the hood in new businesses. The growth in the revenue is led primarily today by two verticals. One is the marketplace vertical, which is driven by two business models. One is the classifieds model, where we charge customers a subscription. That model has seen a very strong momentum of growth in the last 2 quarters. And we continue to expect strong growth there. And we expect that we were expecting that business to break even probably by end of this year as in December 25 to March 26 broadly. I think that business looks to be on track in that particular zone. The second vector of growth is the vehicle finance business, which is basically a partner-led model where we originate loans for origination fee and a loan service fee income for our partners. That is the other vector of growth, which is again compounding at a very healthy pace of probably close to again doubling. Both these businesses are probably close to doubling on a year-on-year basis. And joining the party is basically now the fuel sensor model, where you will see probably in 6 to 9 months down the line, you would see fuel sensor also starting to make material moves in the growth businesses, providing the much needed lift in the revenues from the overall growth businesses. So I would say that broadly, whatever we are selling. So I think this is the color on what is the split of these. So today, materially, marketplace, the loads marketplace business and the vehicle finance business are contributing to majority of this particular uptick. But as we move forward in the next couple of quarters, fuel sensor will also start contributing. This is the color in the overall.
Just to clarify, fuel sensors is not part of telematics; it's part of growth businesses. I believe telematics is within core.
Fuel sensor is part of the telematics business vertical. Under telematics, you have GPS and you have fuel sensor. Tolling and GPS are part of the core businesses. Fuel sensor is not part of the core business.
Understood. At least, I think telematics at least is roughly 15% the size of our overall revenue. Can we at least get the revenue number for telematics?
We will probably, take this request and we will come back probably next earnings. We'll look at it and we'll come back.
Sounds good. And my second question is on the line of basically our platform partners. So if there is any update in terms of people joining us on FASTag side, on vehicle financing side, fueling, I understand like there's limited scope, but any update on more partners?
Yes. So there's an update on partners. We've full-fledged launched one new partner in the FASTag space with commercials much better than the existing commercials. So that gives a good flip, point number one. Second is that, as you all have seen that we've applied for the PPI license in the, DRHP, right? We are pursuing that strongly, and we expect ourselves to be a full-fledged FASTag provider, over the due course. Next update on partners is in the vehicle finance business, where we've been able to onboard a new bank, to disburse loans on our platform. And again, this partner is more onboarded on the CLM2 model, where they will take 80% of the vehicle loan originations, and then they will have full risk on that, right? Then, so again, it's a partner-led model where, whatever you see in the, financials, that's the sort of risk sharing. Then that's the model, right? Then in terms of telematics, it's not partners, but we've been able to crack very strong manufacturing partnerships, both in India and in China, which is giving us further advantages in procurement in the base GPS device and incrementally even in the AIS device, which is going to be the future device in the country, on the GNSS side, etc. So in both the areas of basic GPS device, we've been able to crack manufacturing partnerships, which is enabling us, lower cost of procurement in the future. Then, obviously, as I was mentioning, in the fuel sensor, we were able to again crack a better quality product at a much better price with newer manufacturing partnerships, which is again helping us, drive growth. So each of our businesses, as you rightly asked, Sachin, that we are, partnering with various different people, either be it manufacturing companies or be it with financial services partners to originate loans, or be it banking partners, to do, prepaid cards, etc. In all of these, we are continually improving in the existing partnerships. We are signing up newer partnerships with better terms, which is helping us improve our funnels, helping us improve our business, and we are continuing. And that's a continual part of the business for us.
Perfect. Can I squeeze in one more question, or I should get it back into you? I'm fine either ways.
Sure, Sachin, go ahead, please, quickly.
Sure. The third question is largely on tolling market share. I understand the tolling business, the overall industry is growing roughly 13-14%, while our GTV overall on payment side is growing 35%. Where do we stand in terms of market share roughly, and where can we potentially plateau, if that's one question you can take?
So last financial year, basically we blended the market share was close to about 33%, right? As we remember, which were disclosed in the RFP. This year, by June, we were at about 37, right? By December end, by I think September end, last time we gave that number that we were at 40. By December end, we already reached close to about 43%.
Understood. And where can it potentially plateau if you see such a plateau happening ever?
We continue to execute. Market's pretty open for us because nobody's really building customized specific products for truck operators. Our uptimes are the best. Our incremental value props are the best. Our other products, again, are the best. The customer sees like a total value prop to really work with us. Our servicing is the best. Nobody has 9,000 people on the ground. So, so we will continue to execute, and I think whatever we're seeing in the hindsight, I think we will probably at least keep doing that for the next couple of years.
Sounds good. Thanks so much, and all the best.
Thank you very much. A request to all the participants, kindly restrict to 2 questions per participant and join the queue for a follow-up question. Next question is from the line of Gaurav Rateria from Morgan Stanley. Please go ahead.
Hey, hi. Congrats on good execution. I have actually 4 questions. Feel free to dodge it if you think it's too much. I'll get back in the queue. So my first question is on program management fee update, the regulatory update. How frequently that update comes? Is there a annual revision that happens, or is it ad hoc, like it can happen in 2 years, it can happen in 4 years? The second is, what is the implication of getting a PPI that you have applied for? You kind of, covered by regulatory guidelines, which you are currently not. And Also, from a unit economics perspective, you have the potential to get the entire unit economics rather than sharing it with a partner right now. The third question is on the fuel sensor. What's the starting price point right now versus alternate options available in the market, which is making you completely disruptive in this market, and you can kind of penetrate much deeper? And lastly, why should the employee cost, even ex of ESOP, fall on a sequential basis when you're growing the business so healthily? Shouldn't the employee cost also grow, of course, at a slower rate than revenue, but why should it fall in absolute terms? Thank you.
Yeah. So first question on MDR certainty, Gaurav. In the history of the whole program management fee, by now it's roughly close to about 11, 12 years government has been operating this program. The revision in MDR on the issuance side has only happened once, number one. Number two, the first time the revision happened was basically in the year March 2022 is when the revision happened. When the revision happened, first time, they gave a visibility of 2 years, which was up to March 2024. And after that, there was literally no visibility. And it was deemed that it will continue. But there was still a bit of uncertainty lying around because it was deemed that it will continue, but there was no official confirmation. Now, as we speak, typically government gives out a date, a sunset date for MDR, as it gave in the last notification. As it currently stands out, it's a open-ended date given out, saying that this is the MDR and this will remain as we keep moving forward, because the minimum cost which any company incurs is a bare minimum cost in terms of running the entire issuance stack, and that number for different banks and different players is a number where they just break even at that 1% scale because of the kind of market they're serving. The market we are serving in the 2x2 is a market which basically has least number of tags but highest amount of GTV, because it's a trucker segment, right? India has roughly 12 million trucks, and total vehicles which have a FASTag in the country roughly will be 65 to 70 million. So this 12 million trucks, again, if you break it down, only MNHCV flies on national highways. 4 million trucks out of 65 million vehicles in the country, 65 to 80 million vehicles in the country, roughly, produces 70% of the GTV, right? So basically, for players who are not operating in this segment, in the other segment, typically it's very unprofitable to operate even at 1%. So for government, below that, literally, it's very tough to, operate, right? That's the question on MDR. Second point is on PPI. Our drive on applying for PPI and going for that, for us, is more becoming a full stack payments provider. Today, we depend on a lot of different uptimes and downtimes on our partner servers, on our partners, uptimes. And a lot of these involve a lot of high level of coordination, a lot of effort and cost, right? As we become full stack, the idea is not to really move out of partners, but to also have a stack which can deliver better, number one. And then second aspect is basically on, obviously, economics, because we get to keep the whole share. But the economics will probably, not improve, 25 to 30%, probably will improve in the range of 15 to 20%. So economics, yes, will definitely improve. The second question on PPI and unit economics. Third question on fuel sensor. We used to sell a fuel sensor at 20,000 rupees when we launched. We were able to bring some volumes and bring it down to 15,000. We used to sell it at 15,000 about 4 months back, right? And at that price point, typically the demand was not taking off, because we're talking about a truck operator who typically net earnings probably would be 15,000 to 20,000 rupees per truck per month. Now he needs to curtail theft on fuel. He needs this device, but at the same time, the paying potential is low, right? So today in the market, we started selling the fuel sensor anywhere in the range of blended realization for us is roughly about 10,500 to 11,000 rupees from the fuel sensor, right? In the market, you can find a fuel sensor, lowest is our price, and the range of the price is up to 25,000 rupees, right? For our truck operator, really the sensitivity is that, is the fuel getting stolen in the range of 5 liters and above, right? The sensitivity is not that if half a liter is gone or 1 liter is gone. So the applications are wide, right? So we are essentially building a product customized in such a way that we are able to produce a 99% plus accuracy. We've been able to deliver with a product which the current product is providing 99.5%. We've been able to establish a product which is again providing a 99.5% kind of a reliability in our reading to the customer. And that we've been able to dramatically work on costs, right? And we've been able to bring that down. And that is the reason why we are able to operate at a 10,000 plus price point. And at the same time, we will be able to deliver a contribution margin profile of 70 to 80% on a stabilized unit economics perspective, right? So that's the fuel sensor story on what the market is selling, where we are selling, and why we will be able to outbeat because of focus on the customer segment, what he needs, reliability of the device, because like we have set up a comprehensive lab which tests out the reliability, and we've done like all this grunt work over the last 18 months, which we've been able to crack this device at this point in time. Now, your last question, employee cost reduction, why? Right? Yeah. Satya, you want to take that question? Yeah.
Gaurav, I think two things. One, as we have consistently said, we continue to move more towards variabilization of the workforce, so that you would see that the other expenses has gone up, and that includes manpower and consultancy charges. I think we have explained this on every quarter that that's the intent, to variabilize. That's one. Second, as always, we continue to run a lean team and execution focus. I think the third point, just one time, is that in December, some of our leave lapses, etc. happened. So there are some reversals in leave encashment and gratuity. So that is to the extent of 1.5 to 1.7 crores. But other than that, as I said, continuous focus is on variabilizing the workforce. So you will see the other expenses go up if the employee benefits expense reduces.
Thank you for the detailed response. All the best.
Thank you very much. Next question is from the line of Prateek Poddar from Bandhan AMC. Please go ahead.
Yeah, hi. Firstly, congratulations. I think this quarter EBITDA is more than what you did in H1, so congrats for that. Couple of questions. One is just when I see your GTV versus MTUs, right? The GTV has outperformed MTUs by almost 10%. Just curious, I would have thought that MTU should have also grown, but that hasn't. Why is that so?
Yeah. So the overall transacting truck operators, right, if you look at it, does not only come from payments business, comes from loads marketplace, comes from telematics, comes from, multiple other sources of interactions. And what you are essentially looking at is basically the GTV on payment side, right? Point number one, if you look at the user growth on, in terms of the trucks growth, etc., only on like-to-like payments basis, that number is a little higher than the monthly transacting user growth. 20% number is the overall monthly transacting user growth. A trucks on payments would have grown at about 24-25%. Point number one. Point number two,
on YOY basis.
We get the benefit of. Sorry?
I was asking, this was on YOY basis, right? That's what you're saying,
yeah.
Okay, yeah, sure.
Year-on-year basis, yes, right? Yeah. Second factor of growth is that our GTV in payments gets a compounding impact of India's national road network. India's national road network over the last 3 to 5 years has been growing at a CAGR of 5 to 7%. Now, when India's national highways get built out, right, the state highways, which are typically narrow roads and are inefficient roads from a truck fuel mileage perspective, etc., and from a reachability perspective, the state highway usage is cannibalized by the national highway introduction. Because of that, you'll see more, road ton per kilometers happening on national highways. That's factor number two. Factor number three is that there is an inflationary increase in the prices of toll fares year on year. Roughly in the past, toll fares have inflated at the range of anywhere in the range of 6 to 7% on a year-on-year basis. That again leads to the overall GTV growth. So trucks growth on the platform, which is I mentioned to you 23-24%, multiplied by the same trucks doing more number of kilometers on national highways, multiplied by the toll fare increase itself. All of this leads to GTV growing at a much faster pace than the primary metrics growing.
Got it. No, that's really helpful. The second question was on fuel sensor, right? You said you've localized, etc. Just from a monetization perspective, this is SaaS basis in the sense you charge per month subscription service. Is that a fair understanding?
Yeah. It's the same model. We charge upfront for the first year because that includes the device cost. And after that, it's annual recurring subscription, which again comes for renewal, and it's an annuity income again. Nature of revenue again will be similar as the GPS revenue.
Got it. No, fantastic. And lastly, when I look at, let's say, your growth areas, right? And when I see sequentially, now this question is sequentially. If you see sequentially, your growth areas revenue increase is lower than your core business revenue increase. I would have thought that others, which is basically your new growth area, should have grown at a faster rate. But that hasn't happened. Obviously, it's a very short time. It's on sequential basis. But any thoughts why this has happened?
Yeah. So it's more, as I was mentioning, right, it's more two vectors of growth there. The AUM of lending, AUM of the loans we are disbursing in the financial services vertical, and the marketplace growth. Marketplace growth has continued to grow very strong, right? From a financial services perspective, as you are aware, our partners have been cautious in the past, 2 quarters. That's led to a little bit of dampening, in the growth over there. But other than that, there is, no other challenge. You would see that growth coming through in the subsequent quarters.
Got it. Because Q4 is generally quite strong, right, from a disbursal perspective, etc., and even from an overall movement perspective. So Q4 we'll see the growth coming back. Is that
but
what
this time,
because you've onboarded one more new partner, right?
It is not.
No, I was saying
this time that second quarter growth, as you rightly said. Can you hear me, Pratik? Sorry.
Yeah, loud and clear, boss.
Sorry, can you complete your question, please? I couldn't hear you.
No, I was saying, please go ahead.
Yeah. So I was saying the Q2 for us in terms of disbursements did not see a strong uptick because of measured approach by the partners, right? As we see into this quarter, that measured approach slowly is, going away. So we expect to see better disbursements, but yes, Q3 was definitely measured by our partners.
And my follow-up was, see, if you have added one new partner, he'll get his own demand, right? So from that perspective, is that a fair understanding? Because the new partner is a bank, etc.
That's a fair understanding. Yeah, that's a fair understanding. But Pratik, every partner starts off very cautious. So every partner typically has a strong, a good long incubation time, because it's not like if it's a payments business, you can take off very fast because payments mein you flow through pe income banta hai, there is no chance of fraud, etc. Right? So now when a bank is onboarded, which is basically very cautious about credit quality and all of that, right? So they typically start off slow, start off with only few areas, right? Start off with only like the better quality files, gain trust over a period of time. So I would say in lending, a partner senses us for a good 6-9 months before they go really exponential, and which is also probably a cautiously good approach. And so that's how a launch of a partner happens always.
And lastly, any update on GNSS?
Pratik, sorry to interrupt you.
Yeah, that's okay. Fine.
Come back for a follow-up.
Yeah, fair.
Thank you very much. A request to all the participants, kindly restrict to 2 questions per participant. Next question is from the line of Devendra Wadhwa from Value Prolific. Please go ahead.
Sir, thank you for the opportunity. I wanted to ask that your new segment, your loan matching and vehicle finance, how they are performing and what is the growth coming in? Hello, I'm audible?
We were not able to hear you. No, you were not audible. Can you please repeat your question?
So basically, I'm asking your new segment, like loan matching and vehicle finance, what is the growth percentage coming in?
What is the growth prospects in the future? Is that your question?
Yes, sir. What is the growth percentage coming in currently?
Growth percentage. See, I can't we as we discussed last call, we as a philosophy have taken not to provide guidance. But you can continue to expect the current growth coming through, and we'll keep you posted on incremental information if it is there, more subjectively on the growth initiative.
Okay, sir. I wanted to ask a follow-up question on this. That what is the cost of acquisition of a customer on these segments in loan matching?
What is the cost of acquisition of a customer?
Yes.
Yeah. So basically, like the way to look at it is that as a company, as a whole, we spend about 45 lakhs in marketing across the board, right? And other than that, which is a broad-based marketing, other than that, every other cost of acquisition is loaded on each of the categories, right?
Okay.
So essentially, the customers for cost of acquisition of truck operators for the load matching platform becomes free, because I acquire a customer for FASTag, and customer pays me revenue on FASTag, right? I make revenue on FASTag. After that, the customer becomes free for usage across upsell, cross-sell for any other category, right? So the way we are structured on how we look at customer acquisition cost on our platform is that all the categories, like, all the categories of tolling and GPS are essentially our acquisition categories. Not only acquire, but also deliver profits today. And these customers, when they are cross-sold into load matching platform, the cost is essentially, zero, right? So that's the philosophy in which we run this, run the whole vertical.
Okay, sir. Thank you. This is from my side.
Thank you. Next question is from line of Parikshit Kabra from Peak Advisors. Please go ahead.
Hi, thank you, and congratulations on a great quarter. I wanted to discuss a little bit on the fuel payments vertical, which you haven't mentioned as one of the key verticals that is, giving you the great growth number in your new business verticals. I wanted to understand why that is the case. I know that the FASTag tolling business has regulatory push supporting you, but essentially the value proposition to the customer between the tolling business and the fuel business is very similar, and the quantum is higher here. So why isn't the fuel vertical growing as quickly?
Yeah. See, basically, India, first of all, if you look at the landscape of how India operates, right? And as you rightly said, we launched the fuel vertical also from perspective of a very high value proposition, and also looking at the markets, looking at the Western markets where companies like FleetCor, Vex have done phenomenally well. Edenred have done phenomenally well in the fuel card space, right? So Indian market structure, why is it different from those markets? Is that point number one, we have a oil marketing company structure where there are largely 4 oil marketing companies. There's only 1 private and 3 government-owned, right? So the real intensity to fight, for customers in terms of loyalty, etc., isn't that high. That's point number one. Point number 2 is that customers receive good amount of money in hand in cash, so they continue to still transact fuel in cash, right? So these are 2 big headwinds which basically create create issues in customer stickiness, right? So if you look at our fuel vertical, we make money in that fuel vertical. It's a good vertical. It provides ample value proposition for a customer to, really solve his problems. A digital savvy customer uses very powerfully, the fuel card program, and becomes very sticky. And this drives humongous loyalty for our oil marketing partners as well, because they partner with us so that their customers can be loyal through us with them, right? So we've like obviously worked on this vertical continuously. What we've been able to come to terms with is that because of the nature of the customer we are talking about, and because of the market structure what India has, we have been able to comfortably position a growth rate of 20-25% year on year in that vertical, and we are growing in that manner, and and that's a growth rate which we are expecting, and that's coming through. Until and unless we crack a dramatically different value proposition, which we are again obviously experimenting at this point in time, right? Which really moves the market to adopt this offering very fast, right? So at the moment, I will say that this business will grow with the modernization tailwinds of this industry. How aware a customer becomes, how digital a customer wants to transact, how much really they want to really save money and handle their business in a much more professional way, right? Probably the run rate of growth will get limited to this, and until and unless we unlock something which we continuously are trying to, right? until unless something we are able to massively unlock or a government tailwind provides us that particular opportunity.
Got it. All right. And my second question is from the perspective of the other